After hiking rates again, politicians of the ECB and the Fed go into their summer recess. With these rate hikes at the end of July, it's not only the beginning of the summer break, it's also the beginning of a break in interest rate hikes. We argue that with rates between 5.25% and 5.5%, the Fed has reached the plateau of interest rates, and the ECB's deposit rate of 3.75% is also the upper level. Now, central bankers can wait and see how their earlier measures fit through the economy. And there we see, particularly in the manufacturing sector, that the tightening in monetary policy bites. We have really a sharp fall in the sentiment in this sector, and this is likely to lead to some downside pressure on prices for industrial goods. And this will allow the headline and core inflation rates to come down. On the other hand, we see that labor markets are still robust, and we have still some upside pressure in the service sector. So it will take time before inflation expectations come down and central bankers have the room to cut rates again. We think that the Fed will wait until the second half of 2024, and the ECB will only act at the end of next year and come through with the first rate cut. In our medium-term projections, we have the next step in the interest rates reached at the end of 2025. At the new normal, we will have interest rates on the US at 3.5% and in the euro area at 2.5%. With these rate cuts in the course of 24 and 25, there will be some support for the economy. So 2025, in our next 5 years forecast horizon, will be the upper peak of economic activity. Afterwards, we think that the 4Ds will be the dominating factor for the economic and inflation environment. The 4Ds, it's digitalization, decarbonization, deglobalization, and demographic change. In sum, these are likely to lead to a lower growth outlook and some upside pressure on the inflation side. There are some positive risks, particularly coming from artificial intelligence to boost productivity. And there might be some increasing investment activity at the end of the forecast period in decarbonization, because most governments want to reach their 2030 CO2 targets. But taking this away, there are also headwinds, and this comes particularly from the deglobalization side. But taking away a significant deterioration of global trade and interactions, we think that all this will be in a manageable situation. So we are looking forward to moderate growth and moderately higher inflation with central bankers are able to deal with it. We are not arguing that we go in a derailing economic situation going forward. This would only take place if there will be a big geopolitical hiccup.